January 2026 marks a significant inflection point for the U.S. Social Security system, with confirmed payment schedules intersecting with a quieter but potentially more damaging development: the expansion of bank-side fees that can directly reduce what beneficiaries actually receive. The Social Security Administration has finalized the January 2026 disbursement calendar for SSA retirement benefits, supplemental security income, and Social Security disability insurance, locking in dates that affect more than 72 million Americans nationwide. At the same time, changes in banking policies, payment processing rules, and account maintenance structures are converging in a way that introduces new financial friction at the point of deposit. This is not a hypothetical risk. It is a structural shift already visible in account statements, bank disclosures, and updated fee schedules that take effect as calendar year 2026 begins. The core issue is not whether payments will go out on time. The issue is whether the full amount will reach recipients intact, or whether incremental fees, delays, and administrative deductions will quietly erode monthly income for seniors, disabled workers, and low-income households who are already operating on fixed budgets. Before continuing, if this information matters to you or someone you care about, take a moment to like the video, subscribe to the channel, and turn on notifications. These updates move quickly, and staying informed early can make a measurable financial difference. Under the January 2026 payment framework, the SSA continues to rely on its staggered Wednesday schedule for retirement and SSDI beneficiaries, with payment dates determined by the recipient's birth date. Supplemental security income follows its own schedule, typically paid at the beginning of the month unless adjusted for weekends or federal holidays. On paper, this structure looks familiar. Operationally, however, the environment around those payments has changed. Over 99% of benefits are now delivered electronically, either through direct deposit to a bank or credit union account, or via the Direct Express prepaid debit card program. That level of digital dependence means beneficiaries are no longer interacting primarily with the SSA at the point of payment. They are interacting with financial institutions, payment processors, and card networks, each with its own fee architecture, settlement timelines, and exception rules. In January 2026, those rules matter more than ever because many banks have updated their consumer account terms to reflect higher operating costs, increased fraud mitigation expenses, and new compliance requirements tied to federal and state regulations. The most immediate risk comes from overdraft and non-sufficient funds policies that activate automatically when a Social Security deposit posts later in the day than expected, or when a pre-authorized payment clears before the benefit hits the account. Even a timing difference of a few hours can trigger cascading fees. In 2026, standard overdraft fees at major U.S. banks still range from approximately $30 to $38 per occurrence, and some institutions allow multiple fees per day. For a beneficiary receiving an SSI payment of around $943 per month, or a modest SSDI benefit, a single overdraft can consume a meaningful percentage of that income. The SSA does not reimburse these fees. The bank does not waive them automatically. The loss is immediate and in many cases permanent unless the beneficiary actively disputes it. Geographically, the impact is uneven. Rural areas with fewer community banks and limited credit union access are more exposed because beneficiaries are more likely to rely on large national banks or prepaid card services with rigid fee structures. In parts of the Southeast, the Southwest, and portions of the Midwest, SSI and SSDI recipients disproportionately use prepaid debit cards due to barriers to traditional banking. These cards often carry monthly maintenance fees, ATM withdrawal fees, balance inquiry charges, and out-of-network penalties. While each fee may appear small in isolation, the cumulative effect over a year can exceed several $100s. In January 2026, updated card program disclosures show that some fee-free thresholds are being raised or eliminated, meaning more users will cross into fee-paying territory without changing their behavior. Another critical factor is the interaction between federal payment timing and private sector settlement systems. The SSA releases funds to the Treasury, which then initiates electronic payments through the automated clearinghouse network. Banks are not required to make funds available the moment they receive the ACH notice. Some institutions provide early access as a customer service feature, others do not. In January 2026, several banks have revised their early deposit marketing language, clarifying that early access is not guaranteed and may be suspended during periods of high transaction volume or system maintenance. That creates uncertainty for beneficiaries who schedule rent, utilities, or loan payments based on early deposit patterns rather than official payment dates. When early access disappears without warning, automated payments can fail, triggering late fees from landlords, utility companies, or lenders in addition to bank penalties. The economic context amplifies these risks. Inflation may fluctuate, but fixed-income households remain sensitive to even minor cost increases. Housing costs, medical copays, prescription drug prices, and energy bills continue to consume a larger share of monthly budgets for seniors and disabled individuals. In that environment, losing $35 here or $50 there to bank fees is not an inconvenience. It is a destabilizing event. It can force trade-offs between food and medicine, between heating and transportation. The SSA benefit formula does not account for these downstream losses. Cost of living adjustments are calculated based on inflation indices, not on financial sector fee inflation. As a result, even when nominal benefits rise, real purchasing power can still decline if transaction costs increase faster. There's also a compliance and enforcement dimension that receives less public attention. Federal law protects Social Security benefits from garnishment in most cases, but those protections apply to the benefit itself, not to fees assessed after the deposit lands in a private account. Once the money is in the banking system, it is subject to the institution's terms and conditions. In January 2026, consumer advocacy groups have flagged this as a regulatory gap. The funds are protected in theory but vulnerable in practice. Enforcement actions against abusive fee practices exist, but they are retrospective and slow. For the individual beneficiary, relief often comes too late. The SSA has acknowledged awareness of these issues but maintains that its authority ends at the point of payment initiation. The agency's operational focus remains on accuracy, eligibility, and timeliness. In internal briefings and public statements, SSA officials emphasize that beneficiaries are responsible for selecting and managing their payment method. That position shifts risk onto individuals who may lack the financial literacy, mobility, or digital access needed to comparison shop for low-fee accounts. In January 2026, this structural imbalance becomes more pronounced as banks consolidate and fee schedules become more complex rather than simpler. From a systems perspective, the convergence of a fixed federal payment schedule with variable private sector fee regimes creates a predictable pattern of stress points. The first week of January is one. So is any month where the first falls on a weekend or holiday, pushing SSI payments earlier or later. Each deviation from the normal pattern increases the likelihood of misaligned transactions. Each misalignment increases the probability of fees. This is not random, it is systemic. And systems produce outcomes at scale. The stakes extend beyond individual households. When millions of beneficiaries lose small amounts of income to fees, the aggregate effect ripples through local economies. Social Security benefits are spent quickly and locally, supporting grocery stores, pharmacies, landlords, and service providers. Reducing net benefits reduces local economic activity, particularly in regions with high concentrations of retirees or disabled workers. In January 2026, as payment schedules and fee structures intersect, this drag becomes measurable. Economists tracking regional consumption patterns note that even marginal reductions in transfer income can affect employment and business stability in vulnerable areas. There is also a political dimension. Social Security remains one of the most closely watched federal programs, and any perception that beneficiaries are being shortchanged, even indirectly, carries consequences. While bank fees are not set by Congress, the public does not always distinguish between federal policy and private sector practices when outcomes converge. Pressure builds on regulators, lawmakers, and the SSA to intervene, clarify, or reform. In the past, such pressure has led to changes in direct express contracts, disclosures, and consumer protections. Whether January 2026 becomes another inflection point depends on how visible the impact becomes and how quickly affected beneficiaries mobilize. Operationally, beneficiaries face a narrowing window to mitigate risk. Reviewing account terms, opting out of overdraft programs, switching to no-fee accounts, or adjusting payment schedules requires time and effort. For some, especially those with cognitive impairments, language barriers, or limited internet access, these steps are not trivial. The system assumes a level of agency that does not always exist. As a result, the most vulnerable are often the most exposed. The broader strategic question is whether the current model of benefit delivery remains fit for purpose in an environment of rising financial complexity. Electronic payments are efficient, but efficiency without safeguards can transfer costs downstream. In January 2026, that tension is no longer abstract. It is visible in account statements, customer service calls, and advocacy reports. The cause and effect chain is clear. Fixed incomes meet variable fees, timing mismatches trigger penalties, penalties reduce net benefits, reduced benefits increase hardship. Looking ahead, uncertainty dominates. Banks may adjust fees again, regulators may respond, or they may not. The SSA may issue guidance, but guidance does not override contracts. Beneficiaries may adapt, but adaptation has limits. What is clear is that January 2026 is not just another payment cycle. It is a stress test of how federal benefit systems interact with private financial infrastructure under pressure. The outcome of that test will shape not only monthly bank balances, but confidence in the reliability and fairness of the system itself. The question is not whether changes are coming. The question is who will bear the cost when they do.